This is a story about you. Well, about you in fractional reserve banking, that is. Suppose you suddenly find yourself with $100. Of course, you do a happy dance. Then you take it to your bank, the Bank of Terry, let's say, and you ask them to put all $100 into your checking account. You put it into your checking account because you plan to go spend it using your debit card, and then you go and buy stuff. At this point, the Bank of Terry has your $100 in their vault. And for right now, let's call that Bank of Terry's reserves. Now, along comes another student of macroeconomics, and they go into the Bank of Terry and say, I need a loan. The Bank of Terry lends them $80, keeping $20 in reserve, because that's the policy of this story. Banks have a reserve requirement of 20%. That means for every $1 from depositors like you, they have to have at least 20 cents in their reserves at any given time. The new borrower of $80 then goes to their favorite bank, the Bank of Pat, and deposits all $80 into checking. So the Bank of Pat now has $80 of your original $100 in their vault, which we'll call their reserves. The happy student takes their debit card and goes off to buy stuff. Along comes yet another student of macroeconomics, and they go into the Bank of Pat and say, I need a loan. The Bank of Pat has to keep 20% of the $80 deposit, so they'll lend out $64 and keep $16 in reserves. That student takes the $64 over to the Bank of Chris, puts it all in checking, and goes off with their debit card to spend it. Of your original $100, you're off spending $100, the second student is spending $80, and the third student is spending $64. That's $244 of spending from your original $100. Now along comes a fourth student of macroeconomics, and they go into the Bank of Chris and say, I need a loan. Bank of Chris keeps 20% of the $64, or $12.80, in reserves and lends out $51.20. This student now takes this money and starts buying stuff. Now your original $100 has turned into 100 plus 80 plus 64 plus 51.20. That's $295.20 worth of spending going on. And this goes on forever until in the end your $100 results in $500 worth of spending. That's because the total money added to the economy is the original money, that's your $100, multiplied by 1 over the bank's reserve ratio. See the video about money multiplier math to see the math behind this. While this is the basic idea of fractional reserve banking, the actual money multiplier is a bit more complicated. We'll also discuss that in the money multiplier math video.